At our strategy, we use a structured macro framework to understand risk. We focus on sequencing, not prediction. The goal is to see where stress is likely to show up first. This is not a crash call. It is a warning about leadership risk and timing. Markets can look calm right before volatility changes the rules. This analysis is based on a recent Thoughtful Money interview with Mark Newton from Fundstrat. He is outlining a choppy year with the potential for a meaningful drawdown. Our job is to translate that into what actually matters now. The direction is higher volatility. The magnitude discussed is a possible 15 to 20% decline. The relationship is leadership fatigue rather than an earnings collapse. This is happening because the same stocks have carried the market for years. When leadership gets crowded and momentum fades, small shocks tend to travel further. In our strategy terms, this is a shift from phase 1 toward phase 2. That means trends may still exist, but fragility is rising underneath. This is when discipline starts to matter more than conviction. If this continues, index exposure becomes riskier than it looks. Concentration hides inside benchmarks. That is usually where downside pressure shows up first. We are seeing signs of rotation away from mega-cap leadership. Other sectors may hold up better, but the index can still struggle if its biggest weights stall. High beta growth and crowded narratives become fragile in this phase. This is why upside stories can stay true while prices still fall. Timing and positioning start to dominate fundamentals. If this kind of signal-based framing is useful, subscribing helps you stay oriented. It gives you repeat exposure to how these phases evolve, not just one-off opinions. That way you are not relearning the cycle every time volatility shows up. The interview also highlights parabolic behavior in metals. Trends can stay up while risk-reward gets worse. Late-stage enthusiasm usually increases drawdown speed. This happens because attention arrives after the move. When that happens, pullbacks tend to be sharper even inside long-term uptrends. Energy and industrial signals look more constructive. That often happens when markets rotate from growth expectations to real economy exposure. It does not stop volatility, but it changes leadership. We do not react emotionally. We tighten rules, shorten decision windows, and preserve flexibility. Optionality matters more than squeezing returns. This is educational macro analysis only. It is not financial advice. What changed is the probability of a corrective regime. Leadership fatigue is no longer hypothetical. That raises the cost of complacency. This does not end the secular bull case by itself. It does not guarantee a crash. Confirmation still matters. Over the next several months, Phase 2 risk is rising. Phase 3 only comes into play if liquidity and credit break. We watch signals, not headlines. This hits concentrated portfolios first, it hits leverage next, and it hits those relying on benchmarks as diversification. Credit to Thoughtful Money and Mark Newton for the original discussion. Our role is translating signal into structure.